All right, let's dive right into the latest earnings from Sportsman's Warehouse, ticker SPWH. And, this one's a real head scratcher. On the surface, the numbers looked pretty good, but the market's reaction? Well, that tells a completely different and way more interesting story. So here's the central puzzle we're trying to solve. The company beat revenue estimates, they posted some real growth, but the stock action tells a completely different tale. So, were these earnings actually good? Or did the market see something that the headline numbers were hiding? And just look at this disconnect. It's pretty wild. During the day, the stock was on an absolute tear, ripping higher by a full 14% into the close. But then, as soon as the earnings report dropped, bam, the stock just gave back half of that gain, falling 7% in after-hours trading. So what gives? Why did investors get such cold feet so fast? To figure that out, we've got to look at the scorecard. The headline numbers were definitely decent, but as you're about to see, the devil is always in the details. First up, the top line, total revenue. It came in at nearly $294 million. That's up 1.8% from last year, and more importantly, it comfortably beat what the analysts were looking for. So on its own, that's a clear win. Check one in the good column. Now let's look at the bottom line. The company posted an adjusted loss of 12 cents per share. And while, you never want to see a negative number, this was exactly what Wall Street had penciled in. So we can call this one neutral. Not a beat, but certainly not a disaster that would justify a big sell-off. And here's a really encouraging sign, especially for a retailer. Same-store sales grew by 2.1%. This is huge because it shows that existing stores are actually getting more productive. And this is the second quarter in a row they've seen growth here, so management's pointing to this as proof that their turnaround plan is really starting to take hold. So let's just put it all together here. You've got a revenue beat, you've got inline earnings, positive comps, and even expanding margins. I mean, on paper, this looks like a solid quarter. So that brings us right back to our main question. Why on earth did the stock sell off? To find the answer, we have to look behind the numbers. Yep, it's time to dig a little deeper, because this is where the bull case, the optimistic view, starts to clash with the bear case. And it's the bear case that clearly spooked the market after hours. And this right here illustrates the mixed picture perfectly. The growth wasn't even across the board. Not at all. Fishing was a huge winner, up almost 11%, and their core hunting and shooting segment grew a solid 4%. But look at the other side. Camping was a major drag, down the full 10%. That's a really significant weak spot in the business. But okay, here it is. This is the real reason for all the skepticism, the balance sheet. Management made a huge bet and intentionally pulled forward a ton of inventory for the fall hunting season. It swelled to over $443 million. And to finance that, their net debt climbed to $195 million. Management says, hey, this is strategic. But for investors, it just screams risk. I mean, what if all that inventory doesn't sell? So what's the plan to navigate this? Well, they're running what they call a localization plus digital playbook, and it's all designed to make them more competitive and a heck of a lot more efficient. This playbook really comes down to 4 key things. First, inventory precision, getting the right stuff in the right store at the right time. Makes sense. Second, local relevance, tailoring what they sell to specific markets, which has been a big win for them in places like Alaska. Third is a big push into personal protection. And finally, just building up that brand awareness with campaigns like Adventure Like a Local. Their CEO, Paul Stone, really summed up their whole strategy perfectly with this quote. The goal is to hit that sweet spot, right? To be more specialized and locally in tune than the giant big box stores, but have a way better selection than the small independent shops. This is the strategic high ground they're trying to own. So after weighing the solid top-line performance against that pretty obvious execution risk, what's our final verdict on the stock? We're landing on a market perform rating. Look, we have to acknowledge the positive momentum in sales, but we also have to respect the huge execution risk here. The entire story for the rest of the year really hinges on one question. Can they sell through that mountain of inventory and start paying down that debt? All right, and now for our not financial advice segment. Based on everything we've talked about, we've sketched out a plausible trade idea we're calling the sell-through and deleverage play. The thesis is simple. The market is over-punishing the stock right now because of that inventory risk. If you believe management can actually execute, a successful sell-through in the second half of the year could lead to the stock getting re-rated higher. Now, for a more advanced trader, one way to structure this is with a short-dated, out-of-the-money call option spread. That gives you upside exposure. But what about the downside? Well, you could pair that with a long position in a credit default swap, or CDS, to protect against that big risk of execution failure. And, as always, please remember this is not financial advice.